Gold just crossed $4,000 per ounce this week. Goldman Sachs is projecting $4,900 by the end of next year. Newmont, the world's largest gold producer, jumped 140% this year alone. BlackRock's analysts are calling gold miners ridiculously cheap despite these jaw-dropping gains. Meanwhile, central banks around the world have been buying gold at record rates for months. China stacked gold for 11 consecutive months through last month. Official numbers claim 2,300 tons in reserves, but analysts believe the real figure could be triple that amount when you factor in state-owned enterprises, sovereign wealth funds, and off-balance sheet holdings. Something fundamental is shifting beneath the surface of the global financial system, and most people have no idea what it means. This video breaks down exactly why gold is surging, what China's hidden accumulation strategy reveals about the future of the dollar, and how the financial architecture of the next decade will look completely different from anything we've known. By the end, you'll understand the forces reshaping global finance right now and what that means for anyone holding dollar-denominated assets. Stay until the final minutes because I'll walk through a framework for evaluating your own exposure to these shifts and the questions you need to ask yourself about how your wealth is positioned. And I'll show you why the decisions you make in the next 6 months will matter more than the last 10 years combined. Let's start with the signal everyone's seeing but few people understand. Gold breaking $4,000 isn't speculation or a bubble inflating on hype. It's a vote of no confidence. When the institutions that control trillions of dollars in assets move into gold at this pace, they're telling you something about the system they no longer trust. The catalysts are stacking up. The Federal Reserve started cutting rates again after hiking aggressively for 18 months. Government shutdowns earlier this year shaved nearly 0.2% off GDP every single week they dragged on. Geopolitical tensions between the United States and China have reignited over trade, rare earth export controls, and technology restrictions. The Middle East remains a powder keg. Inflation has cooled slightly but still runs above where central banks want it. And layered over all of this is a creeping realization that the era of cheap money, unlimited liquidity, and consequence-free money printing is over. Goldman's projection of $4,900 per ounce isn't coming from thin air. They're modeling continued central bank purchases, persistent inflation concerns, and weakening confidence in fiat currencies. Some independent analysts are floating $5,000 if the dollar's reserve status erodes faster than consensus expects. The mechanics are straightforward. When real interest rates stay low or negative after accounting for inflation, holding cash becomes a losing proposition. Investors and institutions shift into assets that preserve purchasing power. Historically, gold has served that role for thousands of years. No government can print more of it. No central bank can devalue it overnight. It's the asset that survives regime changes, currency collapses, and financial crises. Central banks understand this better than anyone. Over the past 2 years, they've been net buyers of gold at levels not seen in decades. Russia, India, Turkey, Poland, Singapore, and dozens of others have added to their reserves. But the most significant player in this story is China. For 11 straight months through last month, China's central bank reported adding gold to its holdings. That's the official story. The unofficial story is far more interesting. Analysts tracking import data, mining output, and financial flows estimate China's real gold reserves could be somewhere between 6,000 and 7,000 tons when you include holdings outside the central bank's official balance sheet. China maintains separate accounting for monetary versus non-monetary gold, creating deliberate opacity around the true scale of accumulation. State-owned enterprises buy gold, sovereign wealth funds buy gold, private entities connected to the government buy gold. None of that shows up in the headline reserve figures reported to the IMF. Why does China bother hiding the full picture? Because revealing the actual number too early would destabilize the very system they're preparing to move away from. If the world knew China held 7,000 tons of gold and was actively positioning for a post-dollar financial architecture, it would trigger panic selling of dollar assets, a rapid revaluation of gold, and potentially a chaotic unwinding of the existing order. China doesn't want chaos. They want a controlled, methodical transition where they hold leverage and the West scrambles to adapt. The catalyst for this strategy traces back to an event that changed the calculus for every non-Western government. In the spring of 2022, Western nations froze $300 billion in Russian foreign exchange reserves after the invasion of Ukraine. That move, while politically understandable, sent shockwaves through capitals from Beijing to New Delhi to Riyadh. The message was clear. Dollar-denominated assets are not neutral. They can be weaponized. If the United States and its allies can freeze Russia's reserves, they can freeze anyone's reserves. For countries that don't align perfectly with Western interests, that's an unacceptable risk. China's response wasn't emotional or reactive. It was coldly strategic. They accelerated the diversification of reserves away from US Treasuries and into gold, an asset that cannot be frozen, cannot be sanctioned, and doesn't depend on Western financial infrastructure. Gold sits in vaults. It doesn't require swift access. It doesn't depend on correspondent banking relationships. It's the ultimate non-confiscatable store of value. And China has been stacking it methodically while the West focused on other crises. The implications are profound. For decades, the dollar's dominance rested on two pillars. First, the petrodollar system, where oil transactions globally were priced and settled in dollars. Second, the dollar's role as the world's primary reserve currency, meaning central banks held dollars and US Treasuries as their main store of value. Both pillars are cracking. Saudi Arabia, the cornerstone of the petrodollar system, has begun accepting yuan for oil transactions with China. Other oil producers are exploring alternatives. Meanwhile, central banks globally now hold more gold than US Treasuries for the first time in decades. The shift is slow but unmistakable, and China isn't just hedging against dollar risk. They're building something bigger, something that could fundamentally alter how international trade and finance operate. Just last week, Russia hosted a financial forum in Moscow where they unveiled a new precious metals exchange. This isn't a typical commodity market. It's designed to allow countries to settle payments in gold, platinum, diamonds, and rare earth minerals without touching the dollar or using SWIFT, the Western-controlled messaging system that underpins global banking. Countries can trade directly using hard assets as collateral. No intermediaries, no exposure to Western sanctions. This is the infrastructure China and its partners have been building quietly for years. The BRICS nations, Brazil, Russia, India, China, and South Africa, have been working on a gold-backed payment system as an alternative to dollar-based settlement. It's not a full replacement for the dollar yet, but it's a parallel system that gives countries a choice, and once that choice exists, the dollar's monopoly begins to erode. The BRICS bloc controls 72% of the world's rare earth mineral reserves. Those minerals are critical for electronics, batteries, electric vehicles, wind turbines, and defense systems. By linking rare earths to gold-backed settlements, they're creating leverage over supply chains that the West desperately needs but cannot easily replicate. Here's the part that should alarm anyone paying attention. 68% of global trade already bypasses the dollar in some form. That's the highest percentage since reliable records began. If the BRICS gold-backed system gains traction and more countries adopt it, that percentage accelerates. When enough trade happens outside the dollar system, demand for dollars decreases. When demand decreases, the value of the dollar weakens. When the dollar weakens, inflation in the United States rises because imports become more expensive. The feedback loop has already started. Most people just haven't noticed yet. And China holds the leverage because they saw this coming a decade ago and positioned accordingly. But here's what almost nobody understands yet. The real battle isn't between currencies. It's between two completely different visions of how money should work. One vision, the dollar system, relies on trust in institutions, central bank policy, and the belief that deficits don't matter. The other vision, the gold and commodity system, relies on scarcity, tangibility, and the idea that value must be backed by something real. And the outcome of this battle will determine who controls the next century of global commerce. Gold is only half of China's strategy. The other half, the part almost nobody is discussing, is rare earth minerals, and that's where the real power play is happening. Stay with me because what comes next explains why the West is scrambling and why certain stocks have surged nearly 500% this year while the broader market struggles. While everyone watches gold's rise and China's stealth accumulation, the real engine driving this shift is often overlooked: rare earth minerals. These metals are the backbone of modern technology, from smartphones and electric vehicles to sophisticated radar systems and advanced defense equipment. China controls roughly 90% of global production of these critical elements. Just yesterday, the headlines focused on gold, but behind the scenes, China quietly tightened export controls on certain rare earth elements, leaving manufacturers in the West scrambling to secure enough material to maintain production schedules. When China restricts supply, the price for companies that rely on these minerals can spike by hundreds of percent overnight. This is not a theoretical risk, it's happening now, and it explains why the shares of the only large-scale rare earth producer in the United States have surged nearly 500% in the past year, even as broader markets struggle to gain traction. Imagine a world where your smartphone battery, your laptop's display, and the magnets in your wind turbine blades are suddenly in short supply. Production slows, costs rise, product launches get delayed, and entire industries face disruption. No government can print more rare earths. They must be mined, processed, and refined using specialized facilities that require significant lead time. When China uses these materials as leverage, they control the leverage over the technologies of the future. It's a silent weapon that most investors fail to acknowledge until a crisis hits. Remember what happened in 2010 when China temporarily blocked rare earth exports to Japan during a political spat? Prices for dysprosium, terbium, and other critical elements jumped over tenfold within weeks. The world realized the vulnerability but never fully diversified its supply chains. Fast forward to today, and the same risks persist on a much larger scale, with new export restrictions looming and Western governments still scrambling to develop alternative sources. If gold is the anchor asset that preserves purchasing power, rare earths are the strategic raw material that underpins entire sectors of the global economy. And China's dominance over both transforms them from complementary hedges into a unified strategy to reshape economic power. The question we must ask is this: if the dollar's strength rests partly on technological leadership and energy independence, what happens when those foundations weaken? When critical minerals become weaponized and the cost of securing them rises precipitously, companies and countries reliant on those inputs face existential challenges. That dynamic is already playing out in boardrooms and government offices, even if it doesn't always make headlines. But the implications for the dollar go much deeper than commodity prices. The dollar's role as the world's primary reserve currency depends on confidence in America's economic and military power, its financial integrity, and the liquidity of its capital capital markets. If strategic inputs like rare earths and semiconductors become harder to access without the permission of export-controlling nations, confidence can waver. Investors may demand higher risk premiums for dollar assets. Central banks might further diversify into gold or alternative currencies. Manufacturing costs in dollar-using countries would climb, fueling higher inflation and reducing real incomes. The chain reaction could weaken the dollar's position gradually or in sudden jolts driven by geopolitical events. So where does that leave the dollar? We are already seeing cracks in its foundation. First, the petrodollar system, the arrangement by which oil trades are settled in dollars, has lost traction as major producers explore yuan and euro-denominated contracts. Second, central banks have gradually shifted their reserves away from treasuries and into gold. Combined with the rise of alternative payment systems among BRICS nations, the dollar's two pillars of dominance are under strain. The shift is not instantaneous. It happens incrementally as countries diversify payment channels, establish new financial networks, and reassess the risks of holding dollar assets. Over time, the share of global trade settled in dollars can drop from 80% towards 60, 50, or even lower. Each percentage point represents trillions of dollars in global transactions moving to alternative settlement arrangements, reducing demand for dollars and magnifying the structural realignment of power. Now let's bring this back home. What does this mean for you sitting behind a desk or watching markets on your phone? It means the financial foundations we took for granted are slowly being remodeled. The issues we've discussed so far, record gold purchases, China's hidden reserves, new payment systems, rare earth export controls, are signals of a larger transformation. To navigate this environment, we need a clear framework that helps us assess risk, identify genuine stores of value, and adapt our portfolios to the new landscape. That framework consists of three simple but powerful steps: assess, diversify, and monitor. Before I show you the full blueprint, here's a critical trap most investors fall into. They assess risk only at a superficial level. They look at percentage allocations to stocks, bonds, and cash. They diversify across sectors and geographies, but they fail to consider currency risk, counterparty risk, and the intrinsic value of their holdings. They monitor headlines about interest rates or earnings reports, but they miss the structural shifts in trade and resource control. As we move into the next phase of this video, I'll walk through exactly how to avoid that trap with a practical example that you can apply to any portfolio, big or small. Stay with me, because if you get this wrong, the decisions you make in the next 6 to 12 months could underperform for years or even face permanent impairments. Now, let's dive into step 1, assessing your exposure across 3 dimensions: currency risk, counterparty risk, and intrinsic value. Currency risk measures how sensitive an asset's value is to fluctuations in the dollar. Cash and dollar-denominated bonds score high on that risk because they rely entirely on the dollar's purchasing power. Stocks in export-oriented companies, especially those dependent on commodity inputs, also carry currency risk because rising input costs and lower export prices can erode profitability. Counterparty risk assesses how vulnerable your assets are to the failure, sanction, or collapse of the institutions that issue or guarantee them. Government bonds of stable nations rate low, while corporate bonds of emerging market issuers rate higher. Bank deposits, money market funds, and exchange-traded products like gold ETFs carry counterparty risk, whereas physical bullion does not. Intrinsic value gauges whether an asset's worth derives from a tangible store of value, such as a metal, resource reserve, or productive capacity, rather than purely financial or speculative narrative. Physical gold, land, energy infrastructure, and rare earth assets score high. Highly leveraged tech stocks with no positive cash flow score low. To illustrate, imagine a portfolio of $100,000. $50,000 sits in a savings account earning minimal interest, and $30,000 is in short-duration treasuries, with the remaining $20,000 in S&P 500 index funds. Across all 3 dimensions, this portfolio scores high on currency risk because it's all dollar-based, moderate on counterparty risk, funds held by banks and the treasury, and low on intrinsic value because none of these holdings is backed by real assets beyond faith in institutions. Now compare that to a balanced portfolio including physical gold, positions in leading rare earth producers, stakes in integrated energy companies, and a small allocation to local currency emerging market bonds. The risk profile shifts dramatically. Currency risk falls, counterparty risk shifts toward assets in multiple jurisdictions, and intrinsic value rises. That comparison reveals where vulnerabilities lie and which holdings serve as effective hedges against the multipolar financial world we've been describing. Step 2 involves diversification across 4 pillars of the emerging system: gold and precious metals, critical minerals and rare earth equities, commodity and energy producers, regional or alternative currency exposures. Each pillar plays a unique role. Gold and precious metals preserve purchasing power across currency regimes. Critical minerals ensure access to the raw materials essential for technology and defense. Commodity and energy producers anchor real asset income and offer inflation protection. Alternative currency exposures reduce dependency on the dollar by tapping into growing trade networks and settlement systems. By allocating capital across these pillars in proportion to your risk scores from step 1, you establish a resilient portfolio architecture designed for a world where financial power is shifting. Now, here's the retention hook for our current block. Most investors think diversification means stocks plus bonds plus cash. They fail to realize that diversification across financial regimes, dollar-based, gold-based, commodity-based, regional currency-based, is the deeper layer they've ignored. In the final section, I'll show you exactly how to translate these pillars into allocations you can adjust based on your own risk appetite and investable assets, along with practical guidelines for monitoring and rebalancing. But first, let's pause to consider the pitfalls of neglecting these pillars. The biggest mistake is assuming that dollar cash and treasuries will always remain safe. That assumption held true for decades under the Bretton Woods framework, but we're moving beyond that era. Another common error is overconcentration in narrative-driven sectors, like unprofitable tech startups or leveraged real estate, while underweighting the very assets best equipped to thrive in a high-inflation, multipolar currency environment. Finally, many investors underestimate the geopolitical dimension. They fail to track how export controls, trade alliances, and strategic resource allocations can shift overnight. Avoid these errors by thinking of diversification not just as sector balance, but regime balance. Next, I want to share a concrete example of how this framework can transform a hypothetical portfolio in practice. Let's say you oversee $1 million in personal or institutional capital. Using a scoring system for currency risk, counterparty risk, and intrinsic value, you identify that your current allocation, 60% equities, 30% bonds, 10% cash, scores poorly. You decide to introduce the 4 pillars gradually. Allocate 10% to physical gold, 15% to leading rare earth producers, 20% to energy infrastructure and commodity funds, and 10% to a basket of emerging market local currency bonds. You trim existing exposures accordingly. Within 6 months, your portfolio's risk profile shifts to significantly lower currency and counterparty risk, with higher intrinsic asset exposure. As gold and rare earth prices continue climbing on structural demand, your returns begin to decouple from US stock market fluctuations. Meanwhile, your emerging market bond allocation benefits from favorable yield differentials as local rates adjust to their own economic conditions. This isn't a promise of performance, it's an illustration of how aligning allocations with the emerging multipolar system can create resilience and potentially capture new growth opportunities. Stay tuned for the final segment, where I'll outline specific monitoring guidelines, what metrics to track, how often to rebalance, and which headline events demand immediate action. Then we'll wrap up with a provocative question that challenges your assumptions about money, power, and the future of global finance. Remember, the difference between reaping the benefits of this shift and being caught off guard lies in understanding these dynamics and translating them into a disciplined, thoughtful approach. Now that you've seen how to assess exposure and diversify across the 4 pillars, gold, rare earths, commodities and energy, and alternative currencies, it's time for step 3, continuous monitoring and adaptation. Think of your portfolio as a living organism, not a static snapshot. The forces reshaping global finance evolve constantly, so your strategy must evolve too. In this section, you'll learn which metrics to watch, how often to rebalance, and the key warning signs that demand immediate attention. First, identify the top 3 indicators that reflect shifts in the multipolar environment. 1. Central bank reserve changes. Track monthly or quarterly reports on central bank holdings of US Treasuries versus gold. If you see further reductions in Treasury holdings alongside sustained or increased gold purchases, the trend of de-dollarization is accelerating. 2. Export control and trade corridor developments. Monitor announcements regarding export permits for rare earth minerals, critical technology components, or oil and gas settlement currencies. When a major supplier imposes new controls or a new payment mechanism launches, you may need to adjust allocations toward affected sectors. 3. Currency settlement data. Watch global trade settlement statistics that show the percentage of trade executed in dollars, euros, yuan, or through gold-backed channels. A steady decline in dollar-based settlement signals that alternative systems are gaining traction. Set a regular review schedule. Quarterly check-ins provide a balance between responsiveness and noise control. At each checkpoint, revisit your risk score matrix from step 1 and recalculate the averages. If your score in any dimension shifts by more than 1 point on a 5-point scale, consider rebalancing. For example, if your counterparty risk score deteriorates due to new sanctions or credit downgrades affecting your holdings, trim those positions and redeploy to lower risk alternatives. Rebalancing guidelines can follow a trigger and tilt approach. Establish trigger thresholds. For instance, if gold rises or falls by 10%, or if a rare earth producer's stock moves by 20%, then decide on tilt adjustments of 5 to 10% of portfolio weight. This systematic approach avoids emotional reactions to headline noise while allowing you to capitalize on meaningful moves. For instance, if gold rises sharply on a fresh geopolitical flashpoint, you might take profits in gold miners and redeploy to energy infrastructure or a yield-bearing currency basket. Conversely, if rare earth equities slump on short-term supply concerns, accumulating incrementally can enhance prospective returns. It's critical to maintain discipline. Avoid the temptation to chase short-lived market fads or react impulsively to sensational headlines. Instead, adhere to your framework. Assess, diversify, monitor. Let data, not fear or greed, drive your adjustments. That said, you must remain agile. Profit opportunities often arise when markets overreact to news cycles. A minor policy tweak can cause temporary blow-offs, sell-offs, presenting contrarian entry points for those prepared to pull the trigger quickly. Now here's a retention moment. Most investors set their portfolios and forget them until the next financial crisis. Don't be that investor. The transformations underway will unfold over years, but punctuated by acute shock events, economic sanctions, trade embargo actions, surprise elections, or technological breakthroughs. Those shocks create volatility spikes that reward readiness and punish inaction. As you implement this framework, document each decision. Keep a journal of why you made each allocation change, what data prompted it, and how you expect the shift to play out. After 6 months or a year, review your journal to refine your process. Are your trigger points too tight, causing excessive turnover? Too loose, causing missed opportunities? This reflective practice will sharpen your strategic edge and help you avoid repeating mistakes. Beyond portfolio mechanics, consider how these changes affect broader financial planning. For example, irresponsible reliance on low-yield cash or government-backed bonds may require longer work horizons or higher savings rates to meet future goals. As the purchasing power of the dollar adjusts downward, the cost of major life expenses, education, healthcare, retirement could rise faster than historical averages. Planning for these scenarios means exploring income diversification, whether through rental properties in stable markets, dividend-producing assets tied to real economy sectors, or entrepreneurial ventures in essential industries like food, water, or clean energy. Institutional investors and governments are already responding. Look for announcements of strategic mineral stockpiles, multi-country pipelines bypassing hostile regions, and central bank discussions of digital currencies tied to hard asset reserves. While retail investors can't directly shape these policy decisions, understanding their potential impact allows you to anticipate shifts in interest rates, inflation expectations, and currency valuations. We've covered a tremendous amount of ground: the signal in rising gold prices, China's concealed reserves, the BRICS parallel system, the rare earth bottleneck, the weakening pillars of dollar dominance, and a 3-step framework for navigating the new terrain. Now let's close with the most important insight of all. The financial rules you grew up with have changed. The stability and predictability of dollar supremacy, the assumption that government deficits don't matter, and the notion that modern economies can indefinitely decouple financial markets from real-world resources. These assumptions no longer hold. We are witnessing a slow-motion realignment of economic power and financial infrastructure. The question is not whether you should invest in gold or rare earths, it's whether your entire financial worldview aligns with this emerging reality or remains anchored to a fading past. So let me leave you with this final provocation. Do you believe the dollar will retain its undisputed position as the world's reserve currency for another decade? Or are we watching the gradual dissolution of that privilege right now? Those who answer the first question will cling to traditional portfolios and may see their purchasing power erode over the coming years. Those who answer the latter will adapt by incorporating the pillars of gold, critical minerals, energy, and alternative settlement systems into their frameworks. Which path will you choose? Share your perspective in the comments below. Let's have a conversation about the future of money, power, and global finance. If this analysis changed how you view the dollar's role in your own financial life, give the video a like and share it with anyone who needs to understand these dynamics. Because in this new world, knowledge isn't just power, it's protection. Thank you for watching.